Rick Rule has dedicated his entire adult life to many aspects of natural resource securities investing. In addition to the knowledge and experience gained in a long, successful, and focused career, he has a worldwide network of contacts in the natural resource and finance worlds. As chairman of Sprott U.S. Holdings, Mr. Rule leads a highly skilled team of earth science and finance professionals who enjoy a worldwide reputation for resource investment management. We caught up with Mr. Rule at the 2013 PDAC conference held in Toronto, Canada, and asked his opinion on a variety of topics.
Do you think that stock markets have run ahead of the economic fundamentals? Are we poised for disappointment in the coming months?
If you're talking about general equities markets, I suspect the answer is yes. I think what you're seeing in terms of the general equities markets is a function of two things. Confidence, born of liquidity, and very, very, very low interest rates, also born of excess liquidity. I think what you're seeing in the markets now is the central banks substituting liquidity for solvency, which I personally think is dangerous. While I like corporate performance and things like the S&P 500, I think that forecasts of an economic recovery are very premature, and I also think that some of the recovery is false.
So what is your outlook for the remainder of 2013 for juniors?
For juniors, I think it's going to be very challenging. What we're going through is a natural and normal correction. The upside that so many people enjoyed in 2009, 2010 was surreal, and the excesses need to be wrung out of the system. What we're going through now is normal and natural. It happened in 1990, 1991, 1992. It happened in 1998 through 2002. Normal, natural retrenchment, and you need to wring out a lot of the excesses that occurred. First of all, in the 2 years, 09 and 10, and then, of course, in a longer cycle beginning in 2002.
So what, in your view, will cause investors to look at junior resource stocks again?
Well, the first thing that has to happen is you have to have a purge. There are perhaps 3,000 listed companies in the world pretending to be in the exploration business. Most of them are actually in the G&A business, general and administrative expense business. And we need to scrape those out of the cycle. When we do that, however, people need to remember that the resource business is a capital-intensive and very, very, very cyclical business. And it is bear market pricing that causes bull markets. It's the snapback from things that are oversold that causes things to do well. That'll be exacerbated this time through because there's, in both the junior mining and the junior oil and gas sector, probably 40 or 50 financially accretive acquisitions that can take place. And these acquisitions will do two things. They'll add cash and they'll add courage to the system. And finally, I believe that sometime in the next couple of years, we are going to be in a discovery cycle, having funded exploration for the last 10 years. People complain about the market that we were in last year, and they neglect to notice that companies like Reservoir Minerals that made a legitimate discovery went from 26 cents to $3.30. Africa Oil, 80 cents to $10. Gold Quest, 6 cents to $1.60. This isn't a market that won't respond. This is a market that's been starved for performance.
So what do you feel will happen with commodities this year?
I suspect sideways this year. I could easily be wrong. I don't see strong enough global demand to take commodity prices up, and I don't see enough terror in the market, in the general market, to take precious metals markets up. What I see is a very normal and very healthy correction, a retracement. Taking the gold price as an example as a proxy, we've been in a secular bull market for gold since the year 2000, and I think this is our 8th correction. Corrections are normal and they're healthy, and I might also remind your listeners to look back to the 1970s bull market, where the gold price went from $35 an ounce to $850 an ounce. In the middle of that spectacular move in 1975, there was a cyclical correction of 50% in a secular bull market. Some people might not like that, but what we like doesn't matter. It's what is.
So what are your favorite resource sectors to invest in this year, and why?
I have made my living buying stuff that other people haven't liked. And what other people don't like right now includes certainly platinum and palladium, which has the best supply-demand fundamentals of any of the precious metals, from my point of view. Uranium, which people love to hate. Thermal coal, which is the most uncool, ungreen metal on the face of the earth. I like developmental stage gold projects. The companies that have decent grade and capital efficient projects have just been taken out and beaten. Gold stocks are never cheap, but this is the first time since 1992 that, from my point of view, the high quality developmental grade juniors have been really, really, really superb propositions. And because I like the gold business, having the opportunity to buy high-quality developmental gold juniors at fair prices, not great prices, is a once-in-2-decade experience.
Do you believe that there's a rotation of assets underway from stocks to bonds, and what would cause that to accelerate?
I believe there has been a rotation from stocks to bonds. I suspect that it's going to go back the other way. If you use the U.S. Treasury as a proxy for bonds, the U.S. 30-year Treasury, the yield on the U.S. Treasury, the 30-year Treasury is so low, particularly in the context of the fact that the purchasing power that you're getting by way of interest relative to the purchasing power that you'll have 30 years from now. I mean, Franz Pick described it, I think, as a certificate of guaranteed confiscation. If the interest rates were to go any lower, which is what it would take for the bond price to go up, if you bought a 30-year bond, you'd have to send them a check every month. I can't see this continuing.
So currently, what are the biggest risks facing the resource sector and investing in the resource sector?
All of the resource sector's worst wounds are self-inflicted. So the worst thing that the customer, that your listener has to face, I mean the worst risk that he or her faces, is really conveniently located. It's to the left of their right ear, to the right of their left ear. They are their own biggest risk. If you want to look at external factors with regards to the mining industry, there is of course political risk. There is a worldwide sense that the political rents, the taxes and the royalties from mining have to go up, which is interesting because mining doesn't earn its cost of capital. They have to go up, but they can't go up. At the same time, we have to provide the copper for China to industrialize. We have to provide the platinum that allows us to breathe the clean air that we breathe as a consequence of that. All the while, we have to share the proceeds of this in terms of social rent while we're not earning our cost of capital.
So do you believe in the commodities supercycle? And if yes, what commodities would you continue to buy?
I absolutely believe in the commodities supercycle. And I think in the context of the next 10 years, you can buy the basket. Having said that, the resource industry is really an assemblage of subsectors. I think that what you're seeing in the world is, in frontier markets, 3.5 billion people becoming slowly more free. And when they become slowly more free, they become rapidly more rich. And what's important in the context of resource markets, what's really important for your listeners to understand, is that when poorer people get more money, the things that offer them utility, the things they buy, are different than you and I. They buy stuff. You and I already have too much stuff. But when poor people get more money, they take their per capita calorie consumption, their family, from 1,400 or 1,500 calories to 2,200 calories. It's something I try not to do, of course. But they upgrade from an adobe house to a cinder block house. They change their roof from a thatch roof to a steel roof. There are massive increases in per capita consumption of resources spread over literally billions of capitas. And if you look at the longest, unbroken bull market in history, it's of course the ascent of man, albeit with ugly, ugly, ugly corrections. But what is going on right now, not just in China and India, but in Indonesia, in Mexico, in Argentina, all over the world, as poor people are becoming slowly more free, rapidly more rich, and they're buying the stuff that these industries produce.
So how do you find investor sentiment this year at PDAC compared to last year?
Retail investor sentiment is healthier this year. Institutional investor sentiment is as bad as I've ever seen it. The fund managers are experiencing redemptions. They aren't selling what they want to sell, they're selling what they can sell. They're selling what has liquidity to fund redemptions. I have never in my life seen institutional sentiment as bad as it is today, which is of course a very healthy sign.
So what sectors are you personally investing your money in these days?
I would say that my biggest ads are in the platinum and palladium sector. I like the precious metals business, and the supply-demand fundamentals in platinum and palladium are so compelling that it really sort of is dominating my own personal imagination in the space. Certainly the uranium sector has been good to me. I've been a very good contrarian buyer of uranium. I was a very good seller when everybody else loved it. I was a very good buyer long before people loved it, so that worked well for me. But the most compelling theme in front of me right now is certainly the platinum and palladium sector.
To get more great interviews with our experts, be sure to check the Education tab on smallcappower.com and be the first to know by subscribing to our daily newsletter.